Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of having Indian mutual funds and dealing with the U.S. tax system, which is an exercise in futility in trying to make any sense of it. We're going to do our best here in a short time to give you a basic understanding. I know I go over this every time, but it's important to understand. The U.S. taxes individuals on their worldwide income. You're a U.S. citizen, a legal permanent resident, a foreign national, don't have to be a visa holder, but oftentimes H-1B, L-1, E2 or E3, O1, even EB5, things of that, then you're taxed on your worldwide income. The U.S. is going to tax all of your income. You could live outside of the U.S. and earn income from a different country, but the U.S. is going to tax you on all of it. Now, you may be able to minimize your tax with foreign tax credits. You may be able to exclude certain income, earned income and housing, if you qualify for the foreign earned income exclusion. But the main point is that if you're a U.S. person, you're taxed on your worldwide income. Mutual funds, right? Mutual funds, ETFs, CCOBs, depending where you're from. Investment, pools of investments, right? So the biggest problem from a mutual fund, let's just say mutual, when I say mutual funds, I'm referring to pretty much all of it, but let's just keep it simple, right? Mutual funds, okay? When a person has mutual funds that are outside of the U.S., they're considered PFIC most of the time. Probably all the time, but there's always exceptions, right? PFIC is passive foreign investment company, okay? Doesn't mean you own some big company that's like a BVI holding company or Hong Kong private limited. It could be as simple as you have fractional ownership, some units, in mutual funds. And with India, mutual funds are very common, growth value, et cetera, et cetera. So what happens if you have mutual funds in India? From a reporting standpoint, well, let's start with the tax. From a tax standpoint, until you actually start receiving distributions, or if there's a redemption, usually switch out sometimes, there's no tax, okay? As that mutual fund grows in there, it stays. If it hasn't left the box that it's in, then generally it's not going to be taxable. The problem is when it is down the line, unless it's in the distributions or in the first year of owning it, you're going to have what's called excess distributions, in which instead of getting long-term capital gain, 15-20%, qualified dividend, 15 to 20%, it all gets taxed at the highest tax rate available, 37, 39.6, plus interest, depending how long you've held that fund for. You could be staring down the barrel of a 50 to 70% tax liability. If you start receiving distributions, it depends on whether it's capital gains or dividends, but at the end of the day, if they're excess, it's a problem. It's normally always going to be an excess distribution. If it's after the first year you get the distribution. So if it's year one, for example, and you receive the distribution, it's not excess because it's not an excess of anything. But if the first distribution you get is 4 years down the road, well, that's in excess. It's going to be considered an excess distribution. You're going to have to go through the exercise of determining the tax liability. With India, one important thing to keep in mind is oftentimes you'll have some funds and they're linked to an ICICI or an access account or SBI. If you have funds or growth, let's say you have dividends shooting out and coming right back in, even quickly, right, within the same day, hour, or whatnot, that could be a problem because now it's left the fund, right? So that could be considered an excess distribution, even though you didn't use it for anything else. From a reporting standpoint, you've got the FBAR for sure. If the funds are in an account or portfolio versus if you're owning them individually, may impact how it's reported. They're generally going to be PFIC reporting on Form 8621. There are some exceptions, the 25,000, 50,000 exception if there's been no distributions anywhere. And that's an aggregate. So it's not like sometimes I get questions, well, it says here if you're married filing joint and the mutual fund is worth less than 50,000, you don't have to report it if there's no excess distributions. It's not 50,000 per fund, it's 50,000 in total, and 25,000 if you're single or married filing separate. If you're out of compliance for prior years and you want to get into compliance, the IRS has plenty of programs available. Beware of the fear-mongering you'll find online. There's the Voluntary Disclosure Program, or VDP, which is for people who are either willful or just can't certify under penalty of perjury that they're non-willful. If you're non-willful, there's a lot more available options to you. Streamlined program, reasonable cause, delinquency procedures. We have lots of free information available on our main website, goldenlawyers.com. We've got some sub-websites to help flesh out more of the specifics to each type of investment. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.